Hey everybody, Chris O'Morrow here with the Washburn Real Estate Group, and I'm sitting down with my really good friend Caleb Janowski. Thanks for joining us, Caleb. Caleb's with the Cornerstone Home Lending at the day team. He's a great option for financing here, and he's going to be helping me go through a little home buyers class that we've been putting together. And we're just going to kind of go through all the ins and outs, both on the contract real estate side and on the financing side. So stick around for some great information. And without further ado, let's jump into this thing. So there's me. I've been in real estate now for just under 5 years. I grew up here in Kitsap, went to school through the North Kitsap School District. Born and bred, and I just love my hometown. Went to school down in UC Berkeley down in California and came right back up and dove into real estate. Been having a great time. Caleb, you want to tell us a little bit about yourself?
Yeah, absolutely. I was actually born in Wisconsin, but I've now called Paulsville home, and I've loved living here. It's been really great, and growing a business here has been a lot of fun as well. I've been with the day team since September of 2018, and I've loved seeing the Kitsap area grow and continue to grow, and so it's been a lot of fun.
Well, we won't hold being a cheesehead against you or anything. All right, so diving in the big picture, what are we going to go over today? We're going to really go in, through the ins and outs. We're going to start with the general process on how to buy your home. Then Caleb's going to take us through the mortgage 101. What does it take to get financing? What are the financing options? And then we're going to kind of finish out with going over some great details as my cat tries to enter. Just go over some great details to know some of the common misconceptions, some of the misinformation that's out there about renting, buying, waiting, all that good stuff. We're going to try to cover as many topics as we can. And so the first that we're going to dive into is just what does it look like? And so this is a great, opportunity. We're going to go over a lot of different terms, and some of these terms are going to be brand new. Some of these terms, you might have seen online as you're doing some research. Don't worry. We're going to go through everything. If you have any questions, it's a great opportunity to reach out to us. We're both available. You can find our contact information on our websites, on our Facebook. Don't hesitate to give us a call, and we're always happy to do this with you in person as well. All right, the home buying process. It's not as scary as it seems. This is a really great graphic. I really like this. It really shows you a ton of information and kind of breaks all the steps down. I'm going to walk us through the first half, and then Caleb's going to take us over on the second half. So first steps first, you got to select real estate agent, and hopefully I'm that person. Not going to be the best fit for everybody, but what we really like to do is sit down and have that consultation, find out what your wants, your needs, your motivators are. Everyone has a different reason why they're looking to buy. And we really want to dive into that and learn a little bit more, because then we're going to be able to tailor our service and really help you to the best of our ability to achieve that goal. And wouldn't you agree, Caleb? The end goal, that's what we're motivated by.
Absolutely. Like you said, we don't succeed unless you succeed as a home buyer, and so that's why we're here. That's why we try to do this. Is we provide a service that a lot of other people do, but we believe we provide it in a different way that makes it unique and makes it special, and that's why we're here trying to walk you through this class is to be able to present you the information and educate you along the way. I know both of us are big believers in knowing and education of the home buying process.
100%. Education is the key to success in this. So once we've selected that real estate agent, the next thing we're going to do is we're going to go and we're going to find the best fit for us on the loan side. I've had great success working with Caleb. One of the reasons that we came together on this And, you know, our communication style is really great. Our clients have been really receptive to that, how we work together in a team, because your real estate lender team, I mean, that's really your backbone as you're going through this transaction. And that can really make and break experiences in real estate, is having that open communication from all parties. So now we're going to go through the pre-qual step. You've probably heard this word thrown around, pre-qualification, pre-approval. They mean slightly different things, but it's something that we're going to really push you to go through, because especially in this market that's been moving so quickly for so long, it's really important that we're as prepared as possible. It's also going to help us because now we know what's a realistic price range for you to be in. You might have your goal set on, I want a 4-bedroom home, 2,500 square feet on an acre, and we know roughly where that's going to be in the price range, but is that realistic for you? And we get lots of people that are surprised both ways. Hey, wow, you know, this is going to be too much for me. We need to scale it back a little bit. Or, hey, whoa, I didn't know that I could be pre-approved this high, and these payments are totally realistic. Let's bump it up. I really can get those 2 acres in Paulsbo.
Yeah, absolutely. And the difference between a pre-qualification and a pre-approval is really documentation. So your pre-qualification is you're going online. Our app is at dayteamlending.com, and you'll pre-qualify. You'll fill out about a 15-minute application. It's going to ask you employment history. It's going to ask you a residency history. It's going to pull your credit. That application is the pre-qualification. Okay, we're pre-qualifying to see what you can get approved for. The pre-approval is reinforcing all of that information with documentation. And that's what a listing agent, that's what a buyer's agent is after is, yes, I know what I wrote down, the approval, and that's the preliminary approval from a loan officer. That's what I do. Okay, that's what you want before you're going out and looking at homes.
Perfect. And that's going to be really important when we get to that contract writing step, which is where we're moving next. So once we've gotten that pre-qualification, that pre-approval, we understand what your criteria is, what the motivator is. Now we're going to start looking at homes. And the great thing is we have just a wealth of ability to look at homes these days. So lots of our buyers are starting their search online. Being able to really preview homes, we're being able to share homes back and forth and narrow that down so that we can, you know, spend quality time looking at the homes that are the best fit for you. And in a fast moving market like this, that's really important because we might need to get out to a house, you know, the next day or the day that it's posted, which can really help to get online, see those pictures, say, hey, this is looking great. Call me up, say, Chris, let's go take a look at this. We can make an appointment that day or next day, run out, take a quick look at it, send it to Caleb, make sure that it's going to fit within the guidelines of whatever loan type we're going with. And then we can say, all right, this is the one. I'm a true believer in finding the right property. You know, I think that we can look at a bunch of different homes. When we find that right home, it's really going to resonate pretty quickly. And that's when we've done all that due diligence to make sure that we're looking at the right properties. We're setting ourselves up for success to do that quickly. So now we're sitting down to write that offer. And we're going to kind of go over the ins and outs of what makes a really strong offer a little bit later. But just knowing we're going to sit down, we're going to go over all the paperwork, we're going to put together a really strong competitive offer in this competitive market. And then we're going to be submitting that over to the listing agent. And that's the seller's opportunity to review that contract. If there's any other competing offers, they might be looking at 3 or 4 offers at the same time. And again, that's why it's important for us to really have crafted that offer. There might be some back and forth. There might be some, a little bit of a counter offer. We might need to negotiate some specific items, something to really make it a win-win for both the buyer and the seller. And then once we have the thumbs up from the seller, they've signed on the dotted line, we're now under mutual. That next step is going to be moving towards the home inspection. So that's a great opportunity for a buyer to bring in a trained and licensed home inspector. They're going to go top to bottom. They're going to get on your roof. They're going to get in your attic. They're going to go through your entire home. They're going to get down into your crawl space if you have one. They're going to look at everything and give you this really awesome report that goes through all the items of your home, whether it's a small minor defect or it's a major item of concern. That's going to come out in that inspection. And then we're going to be able to negotiate with the seller back and forth on those items. Now, after the inspection, we kind of get to the quiet time for myself. And that's when you're really going to be communicating a lot with Caleb as he kind of takes you through the back end of the approval and loan process. So Caleb, you want to go over some of those steps?
Absolutely. So a lot of this is going to happen concurrently. So it's not a seamless process, much like the first half of this is it's going on a lot all at once. So after the home inspection, or sometimes before the home inspection, we'll order the appraisal. And what the appraisal is it's a specific person that goes out to the property that you're looking to purchase and ensures to the bank that that home is worth or valued at what both parties have agreed to pay for it. Okay? You can, if it doesn't come back to value, you can do a couple things. You can negotiate with the seller. They could tell you, no, you agreed to this purchase price, and we want to stay at that. Or you could negotiate the price down to the actual value of the home based on that appraiser's recommendation. That appraiser is going to look at a number of things. They're going to compare recent sales in the area. They might compare the rent schedule if that's a part of the process. But that's the appraisal process. That process usually takes somewhere between 5 to 10 days, depending on the season of appraisals. Okay, we're moving into the loan being processed. The loan being processed is really starting back when you pre-qualify, right? So my job is to collect as much information, like we talked about, ahead of schedule, so that when we do get a contract accepted, we're in a space where we can get the ball rolling on the loan side of things relatively quickly.
Mm-hmm.
That the processor is one member of the loan team. The loan team is comprised of myself, the loan officer, a client care coordinator, a processor whose job is to make sure that your loan is being pushed through the entire loan process, and then an underwriter. And we'll talk a little bit about underwriter here in a second. Okay, so we're in the loan process. Our appraiser is going out to the property. We're also looking at homeowners insurance. Okay, so just like you have car insurance, just like you might have insurance on a ring or renter's insurance, you're going to go and secure a homeowner's insurance policy. There's a bunch of different homeowners insurance agents and companies. It depends on, it's the same thing. It's a fit, whether it's a company or whether it's a specific agent. After you selected homeowners insurance, during that time, your loan is moving from processing into underwriting. The underwriter is the person with the big rubber stamp that says approved, right? They're the person who is comparing your loan and your employment history, your file to the actual guidelines, or let's call them the laws of the loan.
Mm-hmm.
Once we've got loan approval, okay, we will go over to a pre-closing inspection. You'll walk through that with Chris. Then you'll schedule a closing. How closing works is a escrow officer is going to give you a call, and they're going to schedule a time for you to come into the title and escrow company, sit down with a notary, and you're going to sign a bunch of documents. Now, we hear a lot, oh, it feels like I'm signing my life away, right? Our goal is to, with this class, this is the intention, is to make it not feel that way. You've already seen a loan estimate. You've seen closing disclosures, and you've been communicated. You've walked through all of those with myself or with Chris. And so you don't feel like you're signing your life away. In fact, you feel comfortable with the purchase that you're making. And then finally, the cool part here, and Chris gets to do this, he gets to deliver you new keys, and then you're in your new home.
It's definitely the best day of the transaction.
Yeah, absolutely.
Yeah.
Absolutely. That's really, in all reality, the home buying and loan process. Chris, let's move back a little bit halfway. Let's talk about presenting a strong offer.
Definitely. So there's lots of different things that go into presenting that strong offer. And, it's always going to be case by case. It's always going to be client specific. And kind of one of the misconceptions about offers, and while it is extremely important, is that offer price is the only thing that matters. And it's truly not. There's many different addendums, there's many different contingencies, and there's many different facets of an offer that we can use to sweeten the deal, one way or the other for the seller. And part of that, again, comes down to that really strong communication foundation. Real estate is all about communication. One of the first things I'm going to do when you say, hey, let's go look at this house, we're starting to think about, maybe this is the one. I'm going to call that listing agent. I'm going to ask, hey, what would make this an awesome deal for your seller? And sometimes it's something you wouldn't expect. It's, hey, they just got new orders. They're in the military. They're going to be going down to Mississippi, but they've got this specific timeline that they have to meet. And it would be great if we could facilitate that timeline. Then maybe on the buy side, we're a little bit more flexible because we're just crashing at the parents' house for right now until we find the right home. So we can say, yeah, we can be flexible with that closing deadline. Let's put it right here for now, but we'll go into it knowing that we might need to fluctuate a little bit. And as Caleb well knows, when we put that closing date on the offer, that's our best guess that that's when we're going to make it. We're going to do everything we can to make it by that date, but there's a ton of stuff that can throw that closing date off one way or the other. So having that flexibility can be huge for a seller. Some of the other things, and Caleb will go over some of this as well, is a fast closing date. Again, if that's what the seller wants. Having a strong earnest money amount. Lots of numbers are thrown out. Typically, we say between 1% and 3% of a purchase price. Again, hugely case dependent, and that might be something that we're having a conversation between myself, Caleb, and the client to figure out exactly where that sweet spot is that we can say, hey, we've got the cash to close. We're really interested in this property. A lot of people look at the earnest money as kind of a good faith deposit, and it is that way in a lot of cases, but we'll go over, when that earnest money is going to be on the line, when that earnest money is not going to be on the line. And then that last thing is that purchase price. And being able to be really competitive in what we're doing. We're always going to be looking at the market. We're always going to be going over what we think is a smart offer, versus an offer that may be the most competitive, but even in this market is just not a financially wise decision. And that's, again, something Caleb's going to be helping us with. And you might have a little bit more to add on the closing costs and on that price escalator.
Yeah, absolutely. So let's start with earnest money, what earnest money is, right? Earnest money is like you said, a good faith deposit, right? And you're going to, if you get your offer accepted, you're going to the next day go to title and escrow and present them a check to be held in escrow. Escrow is going to be that third party agent that's going to be facilitating all of the cash flow throughout the entire process. Right? We've heard a lot of horror stories of, well, I don't want to lose my earnest money, right? Well, there's some protection that you have along the way, like you were talking about, Chris, that will allow you to retain your earnest money should you want to walk away.
Yeah. One great example of that is the home inspection. Yep. So I think we both have used this term. The home inspection is kind of like the get out of jail free card. So,
yeah, absolutely.
So we've got,
So if we look at this presentation here again, your first contingency is that home inspection, right? Mm-hmm. And I would love to hear your stories of waiving that inspection contingency for as little as what? The siding on the house, or the floorboards, or the paint color.
Yeah. Home inspections are a wild card. We never know. You could go into a brand new turnkey house that you think is awesome, and something is called out that either the home builder didn't do right or they didn't follow current codes. You had no idea. And all of a sudden now everything is kind of thrown, into the wind by this. And it's also going to be hugely client dependent too. We've got some clients that, no, it's okay, we're good, let's move forward. And other clients are going to be a little bit more on the cautious side. And that's, again, where we're going to rely on our expertise in going through many of these situations to help walk you through and explain, what is a major concern when we're talking about a home inspection and what isn't. And the reason we call it that get out of jail free card is that home inspection is really sort of the addendum that we use as a catch-all. So it's kind of, even though we'd rather not have it go this way, if we're under contract and we've got the standard 10-day inspection window, if we're on day 8, we've held the inspection, it went okay, but you're feeling, this just really isn't the right fit. We've spent more time with the home now. It's just not going to be what we thought it was going to be. We can back out of that contract and get that earnest money back. And it's an easy process to go through, one we don't look forward to going through, but one that can add you a little bit of peace of mind and ease that if you really start feeling like it's not the right property, we can use that inspection to get out. And then, of course, if something huge comes up and we're not able to find a middle ground with the seller to get it fixed or to get some cash at closing, depending on your loan type, then we can always back out using that. So it's a really great catch-all contingency.
So that's the first contingency, right?
Mm-hmm.
There's a handful of other contingencies, but the 3 big ones are, the next one's the appraisal.
Yeah.
Like we talked about, should your home not appraise to the value that you agreed to purchase it from the buyer or the seller of the home, you can back out of the transaction at that point or choose to negotiate like we talked about. Mm-hmm. And then the last one is a financing contingency. And in all reality, this contingency should not come up should a loan officer be doing their job. So my goal here is to never have the opportunity to use that financing contingency because we've already done our entire due diligence in making sure that you're a buyer that isn't going to fall apart in transaction.
Yeah.
We've seen some scenarios where it has come up where a buyer quits his job halfway through the process. You need a job to close a loan for the most part.
Yeah. Or goes and buys a truck.
Yep, goes and buys a truck was the next one I was going to say, and adds a huge debt to their financing. So those are a handful of the contingencies that we talked about. And then price escalators, Chris, you've touched on this a little bit, right? It's just an opportunity should your offer, you be in a competitive offer situation, it's the way to escalate your price and just get over that so that you're the winning offer.
Yeah. And that's case by case again, as always. I'll say that a million times, but we do have the ability. It's very similar. I like to explain it like you're setting your max bid on eBay. If we're being a little conservative, the home's priced at $350,000. We want to go in right at asking price because we feel that the competition isn't quite there. We feel we can get it at that price. And then we hear, well, there might be 1 or 2 other offers. And we say, hey, we really want our best opportunity to win this offer. What we can do is we can add this addendum to say, hey, we'd be willing to go up to this price in certain increment amounts if there's another competing offer in. There are ups and downsides to this, and it's something that we'll go over specifically if the case arises. But we do have that opportunity to add a little bit more competitiveness to our offer while still making sure that you're going to get the best deal possible for that home. And again, this is where we'd step in. And if you're saying, hey, we're willing to go all the way up to $450,000, $100,000 above, asking, we might come in and say, hey, let's remember, we still got to pass this appraisal. Is this going to be realistic? We still have to make sure that this makes sense in terms of your payments. For this home, is this still realistic? So it's a conversation that we're going to have when we start diving into those details, making sure it's just a smart offer.
Absolutely. And so we've got your offer accepted. Chris and I have done a good job there of winning your offer. We're moving on to the 4 parts of the loan approval and the story of your loan, right? And so the first part, the major part, a lot of people think of is income, right? So we're asking, these are all the questions we're asking is what does the underwriter see for income, right? The first one is one of our major qualifying determiners is the debt to income ratio. It's aptly named, it's DTI, debt to income ratio, right? And there's a bunch of different loan types out there, and they each come with different ratios. And the ratio is a percentage of your income. We can use a percentage of your income that can be consumed by revolving and installment debt each month. And that varies from 30% to 50% of your income each month. Your gross income can be consumed by debt, which includes your future monthly home payment, right? And so that is a huge window. And again, it depends on which loan program we're choosing. Okay, a 2-year employment history. A lot of times we hear borrowers, well, I can't buy a house because I haven't been with my employer for 2 years. And what we're looking at is not, have you been with your job for 2 years? It's what's the most recent 2 years of your employment situation and what does that look like? You don't need to be with your current employer per se. It's that, can we show a story of employment that's going to be consistent and stable, right? So students directly out of college, before they even started their job, can get approved for a loan because we've got, hey, we just went to school for this, whether it's nursing or whether it's engineering. And now I'm going to be going and starting my career as a W-2 employee with a documented salary, starting salary. We could potentially use that because we're telling the story of your employment.
Right.
Self-employed and contract work gets a little bit harder because you're averaging your income over a couple of years, right? So for a self-employed borrower, let's say you run a grocery store, right? We're going to take the income from your grocery store, not the gross income, but the net income, your take home, what you're documenting on your tax returns. We're going to average that out for 2 years. Contract work is also another one that has its own set of circumstances. Again, but with all of this, we're documenting a story. Mm-hmm. And then finally, additional sources of income, second jobs, those types of resources.
A question I get a lot is, what about rental income there? If I've got a portion of my home, or maybe I'm buying a multifamily.
Yep, absolutely. Yeah, we can use rental income with that. Again, we're going to need to see a couple of things. You can document it in a handful of ways. We can document it through tax returns. If you've had a 2-year history of being a landlord, if you haven't been a landlord, but let's say you're looking to buy a duplex, right? We can use the other rental income from the side of the home that you might not be living in, right? And that'll be documented on, we touched a little bit on it earlier, the rent schedule that comes from the appraisal. Mm-hmm. Okay. Let's look at cash. So this is your down payment, your closing costs, your earnest money, and seller concessions. And what do all of those things mean? So down payment, we hear all the time, I can't buy a house because I don't have 20% down. When in actuality, the bulk of people purchasing homes today aren't putting 20% down because home prices have increased over the course of the last 40 years. In 1980 or 1990, in middle America, when you're buying a home that's only worth $80,000 or you're buying a house that's only worth $60,000, we're getting to 20% seems feasible, right? Now, if we're looking at homes in the $300,000 to $400,000 and we're trying to save up 20%, you're talking about years of savings. And when we're trying to save, that home is also appreciating in value.
Yeah.
Right. So it feels like a losing game at times. So there are down payment options from as little as 0% down, right, to 3% down, to 5% down. And there's pros and cons that come along with each of those different down payment types.
Yeah.
A lot of people, especially new home buyers, they look at the home and go, okay, as long as I've got my 3% down, I can go get a loan, right? There's another cost. What does it actually take to secure a loan, right? That's your closing costs. There are costs associated. There's parties at work that you're going to be paying for, right? Part of that is the loan company, right? That's the origination fees. Okay, you're paying for your half of the title and escrow. We'll talk a little bit about title and escrow later on in the transaction. You're paying for a part of that as well. And then we're talking about funding your property taxes and your homeowner's insurance. You're pre-funding what's called an escrow account, which you'll pay into each month. And we can touch on that in a little bit as well. We've talked about earnest money already. It's a good faith estimate. It is when you go and deposit your earnest money into escrow, that's not a part of your closing cost. That in fact is you get credited that amount towards your closing costs. So if closing costs are run from $6,000 to $8,000, depending on the purchase price and the time of the year that you're buying, right? And you deposit $4,000 of earnest money into escrow, that earnest money will go towards whatever is due at closing.
Yeah. Yep.
Right. And then the last one here, seller concessions. This is a wide array of things that can come from seller concessions. In all reality, we're going real simple. Seller concession is the seller willing to take a portion of their net proceeds and apply it towards your costs of the loan. They can cover your closing costs. They cannot cover your down payment. Down payment has to come from your resources, and it can also come from a family member who might give you a gift. Okay, so if that bottom line there's our equation. Your total funds due at closing at the end of the transaction is equal to down payment plus closing costs minus earnest money minus a seller concession. Seller concession, again, it depends on the environment that you're buying in, right? In an area or in a time where it's very competitive, it might be harder to get seller concessions. In a time where it's less competitive and homes have sat on the market for a longer duration of time, a seller might be more willing to give you a seller concession towards closing because they want to sell their house.
Yeah, very much so. And sometimes this is where a little bit of the emotion of real estate, which is what can make real estate a lot different than any other, sort of transaction you'll go through. Is there's a lot of emotion in real estate, and this can sometimes affect some of these items, some of these seller concessions. We have a ton of military here in Kitsap County, so asking for closing costs to be covered is a pretty common thing that we find. Both being on the listing and the buy side, it can cause a little bit of confusion sometimes for sellers over covering buyers' closing costs, but it is something that we see all the time. And again, that's where we're here to help walk you through and help walk the seller through understanding those closing costs. And if it's something that we can do to sweeten the deal for them or for you, it's something that we might be able to handle. And I love having that equation there to kind of show that we might be able to work some of that out to reduce those upfront costs for you through the process.
Absolutely. And if we were to back up a little bit about presenting a strong offer, that's all part of that equation.
Yeah.
We present a strong offer, adding in that seller concession, the size of the earnest money, that is all factoring into that.
No.
All right. So as we move forward here, another part of your story of your loan is your credit. There's a lot of mythology around credit scores of not wanting to get your credit pulled. There's good reasons for that, and there's bad reasons for that. But the bulk of your credit history comes from your payment history. Have you made your monthly payments on time? Right? Do we have any missed payments from 5 years ago that might be weighing our credit down?
Mm-hmm.
That's 35% of your credit history. Okay. Outstanding balances is 30% of what makes up your credit score, right? And so what we try to recommend is, if you have a revolving credit line of credit, that is a credit card, that's a home equity line of credit, a secured money line of credit. If you have a line of credit like that, you want to keep your balance around 30% or less. So if we have $1,000 credit card limit, right, let's keep our monthly balance at $300 or less. Okay. The length of your credit history is also important. Okay. The longer you have a credit card open, or a student loan open, which is a line of credit, or a car loan, the stronger you are going to appear as a borrower. If you make consistent monthly payments on a student loan or a credit card or a home loan, right, and over the course of 5 years, you're going to look stronger than a borrower who just opened up a line of credit or a credit card maybe 5 months ago.
Yeah. Yeah.
And new credit inquiries, this is where a lot of the mythology around credit scores come from, is I don't want to apply because I don't want to hurt my credit score.
Yeah. Hear that all the time.
Yep. And what, in all reality, when you get a hard inquiry, which a hard inquiry is when we pull all 3 credit scores, that's TransUnion, Equifax, and Experian, a hard inquiry is going to pull all 3 of those scores. And it is going to maybe lower your credit by a little bit, but you're talking about 5 to 6 points.
Mm-hmm.
So an extraordinary amount. When you get into trouble is when you have hard inquiries, maybe 5 times a year, 6 a year. That's where it's going to impact your credit score. And let's break that down. Let's think about why, right? Because credit bureaus like to see stability. They like to see consistency. And so if you have 5 inquiries over the course of the year, they're going, hey, how many lines of credit are they opening up? Right? What do we forecast for moving forward?
Mm-hmm.
Right?
Mm-hmm.
So that's part of that. But if you have a good credit score, which is 700 or above, in the 600s, I wouldn't be fearful about getting my credit pulled because I've got a good credit score. That credit history is there to be used.
Yeah. Yeah.
And then the last one is miscellaneous factors. There's a handful of other things that go in there as well. Credit bureaus inherently aren't necessarily the greatest algorithms that we have to assess a borrower's payability.
Mm-hmm.
Unfortunately or fortunately, it is the score that we use.
Yeah. And I think one thing, if we jump all the way back to the beginning, when we talk about that, the first step is having you go and get that pre-qualification done,
Yeah.
pre-approval, is we're going to do this. We're going to pull the credit score, and we might suddenly find, hey, credit score is not where it needs to be, or hey, if we were able to bump it up just 10, 20 more points, we might get you into a new bracket, and we might be lowering your interest rate a little bit or your payments a little bit. And then Caleb is able to help say, hey, here's a plan. Let's do this. Why don't we pay this credit card down a little bit? Let's open up a new line of credit, or let's call the credit card company and see if they'll up your available credit a little bit so that we can reduce that percentage that we're using monthly. And that might help bump us a little bit. Or it might be, hey, let's take a year. This is a great plan. Let's pay off these debts over the year. And then by the time we hit, this month next year, we'll have a great credit score and we'll be ready to make that purchase that makes the most sense. So, we'd rather not get our heart set on a home and be ready to move forward and then suddenly find out, dang, my credit just isn't where I thought it was. My app's showing me the wrong number, whatever it is. It's great to knock that out in the beginning so that we have a realistic mindset moving forward.
Absolutely. And we get that a lot where these consumer facing credit companies like Credit Karma, they show a very high loan or high credit score. And then when we pull it, it's a little bit lower. The reason being is Credit Karma is using a consumer facing algorithm. So when you get your credit pulled for a line of credit on a credit card or a auto loan or a home loan, those are 3 separate algorithms that are making 3 different risk assessments.
Mm-hmm.
And a home loan, because it is such an high balance debt, right, is going to be a little bit more strict when assessing your payability. So moving forward here, the last part of your loan story is the property itself, right? There's different property types that make up different loans. You've got condos, you've got HUDs, which are a form of condos, townhomes. Then you just have your regular stick-built house in a neighborhood that could be associated with an HOA or a homeowners association. All of these things go into what is making up that loan story.
Yeah.
And then we talked about an appraisal that'll be required by the bank. And then finally, title. What a title company is going to do, and it's required in the loan process. What a title company is going to do is going to go through all the purchase and sales of the transactions that have taken place on the property that you're inquiring about buying, and making sure that the only lien or loan or debt, however you want to call it, on that house is going to be the loan that my company is placing on that house.
Mm-hmm.
You want to be your loan to be, or your lien to be in first position on that house.
Yeah.
Right. We've heard horror stories in the past of a client makes a purchase. This has never happened on one of our transactions, and it hasn't happened in a long time because of the title insurances that have now taken place and the requirements around it. Client makes a purchase, and 20 years ago they got a roof on the house, and whoever was owning the house at the time never paid the contractor, and now that home is in first position, or that lien, that contractor is in first position on getting paid back on the value of that home. Okay, so that's the reason we've got title insurance there, and that's such a vital, important part of the transaction.
Yep. And another thing is, we talked about a few of the big contingencies. There's lots of other smaller contingencies that are going to be case by case. One standard we use is the title contingency. One of the great things is, as we're going through this purchase process, once we're under contract, we're going to get from the title company this huge long document that goes through the whole history of the property, and will hopefully uncover any of those remaining liens or any of those items. If it's an old logging land and someone happens to own the timber rights on your property, and now a year later a logging company comes knocking on your door saying, hey, we're going to clear cut your beautiful forest here because we own the timber rights, that's going to come up in that title process. And if something comes up that is unacceptable, we can use that to back out of the contract. And similarly, that title insurance is going to help protect that. And then from the title company will help protect that if a case were to arise later down the line.
Absolutely. So as we're moving along here in our presentation, we're talking about types of financing. Okay? The components of your payment is a big portion of the types of your financing. And so when we're looking at this, what makes up your monthly payment is your principal, your interest, your real estate taxes, homeowners insurance, and then mortgage insurance if necessary.
Yeah.
So we call that your PITI, right? One thing that's not included on here is homeowners associations due. That's a network within a neighborhood or a condo development that you might live in, and it's an additional fee. The reason it's not included on here is it doesn't come out of your monthly mortgage payment.
Yeah.
So when you make your monthly payment, you'll be making it to one place. It'll be an online servicer, unless you were to choose otherwise. It'll be an online servicer. You're making one bulk payment, and then the servicer is going to direct these different payments to the necessary places. Okay, so your what makes up your principal and interest is your interest rate, right? And then the loan balance on your home. Your real estate taxes, okay, those will change year to year. And then your homeowner's insurance, we talked a little bit about homeowner's insurance, variable rate there. And then mortgage insurance. Mortgage insurance is required on loans that have less than 20% equity or down payment. That's why that mythology around that 20% number exists. In the past, mortgage insurance numbers have been astronomical, $400, $500, $600 on a just a normal $300,000 purchase loan. Okay. In recent years, mortgage insurance numbers have been as low as they've ever been. And the reason being is in the past 10 years, since the most recent housing collapse, right, the home insurance policies haven't had to be paid out because of the restrictions that have been put in on the loan side of things, right? It's a little bit more difficult to qualify for a home because we are taking those necessary steps to check employment via pay stubs. We're making the necessary steps to check your down payment, to check your credit history, those types of things. So there's been less foreclosures. The foreclosure rates are at an all-time low as we sit here in April of 2020, right? And so with that, mortgage insurance companies have had to pay out less policies, and so they charge less. It's actually a very manageable monthly figure now.
Yeah.
With a lot of loans in a conventional loan, that mortgage insurance number will actually drop off. That monthly mortgage insurance payment will actually drop off when you do reach 20% equity in the home. And so that's what makes up your monthly payment. Okay? Your real estate taxes and your homeowner's insurance, when you make your monthly payment, those will be directed into an escrow account. Okay, and that escrow account will be set up, that we talked a little bit about it before. The escrow account is set up at closing. You pre-funded it as a part of your closing costs, and now you pay into it each month. And in the state of Washington, our property taxes are due in the month of April and in the month of October. You don't have to worry about making that $1,000 or $2,000 or $3,000 payment in April and October, because you've been making that monthly payment into your escrow account as a part of your property taxes. Homeowners insurance is similar. It's due once a year, your annual premium, and that will also come out of your escrow account. It's a way that mortgage companies have budgeted for intentionally for borrowers to help with the risk of lending that money. We know that you're going to be able to make your property tax payment and your homeowner's insurance payment because we're forcing you to collect it each month.
Yeah.
All right, so as we move along here, some of the other parts of your loan is the different types of your loan. Okay, we've talked, for the most part, when we talk about a type of a loan, the very basic loan is your conventional or conforming loan. Okay, what is a conventional loan? It's a loan that's backed by Fannie Mae or Freddie Mac, and those are the guidelines or the laws that we're funding to. It's the most commonly used loan because it's the most forgiving in terms of qualifying. It's the least stringent in a way. In our area, our conventional and conforming loan limit in Kitsap in 2020 is $510,000. So any loan balance under $510,000 is considered conventional. Okay, the government loans, those are FHA, which is Federal Housing Administration, VA, Veteran Affairs Loan, and a USDA, which is the U.S. Department of Agriculture or Rural Housing Loan. Those are all different loan types that we can use to get a loan, but they come along with their different increased qualifications that you have to meet, and they come with pros and cons. Okay, so a conventional and conforming loan, okay, that's what we talked about. Having, if you have 20% down payment, you don't have to pay mortgage insurance. If you have less than that, then you have to pay mortgage insurance until you reach 20% equity in the house. For a conventional and conforming loan, the least amount of down payment you can bring, the minimum amount of down payment you can bring is 3%. And those are for first-time home buyers. Okay. For government loans, FHA is great for borrowers who might not have a great credit score. Right? Your credit score might be in the low 600s, right? And FHA has built their loan program to forgive clients on that credit score. But in return, what they charge is an upfront funding fee, right? Which is added into the loan amount, and it's 1.75%. So if you buy a $100,000 house, you have to pay that fee of $1,700. And that's rolled into your loan amount. And then the other part of FHA is they charge mortgage insurance, and a pretty steep mortgage insurance number for the life of the loan, unless you refinance out of that loan. USDA, similar to FHA, the benefit there for USDA is it's 0% financing. That means you don't have to bring any money towards closing. Okay. It also charges a funding fee up front. And it also has mortgage insurance for the life of the loan, but it's quite manageable mortgage insurance. Yeah. So it's great for first-time home buyers in a specific area. The one thing with USDA is it's very strict on that debt to income, so it's an additional qualification. Okay, USDA is also restricted by geographic areas, so it's a rural housing loan. It's intended for areas that might not, its original intention was for farmers to be able to secure loans.
Right.
And then jumbo, non-conforming, anything over that conventional loan limit, you really move into the wild, wild west of home lending. Each company that is offering jumbo loans is going to have whatever additional, what they call an overlay or restriction or guideline that they want you to meet. And it really depends on from the investor to investor. And so if you're looking at a jumbo purchase loan, you're going to want to get with your mortgage loan officer to try to get a really good idea of what's going to be required of you.
Yeah.
All right. So as we move along here, the reality of the market is going to vary depending on the time of year that you buy, and the position that you're in as a borrower.
Mm-hmm.
So as we look at the reality of the market, we're looking at, what can I purchase, right? What can I budget for, right? And so if our goal is to keep our monthly payment around $1,400, right, our purchasing power is going to vary depending on two things: loan size and interest rate.
Mm-hmm.
So right now in April of 2020, interest rates are relatively low, right? And so if we've got a 3.5% interest rate and we've got a $1,400 budget, or around $1,400 budget, we can afford a $400,000 home. Well, what happens if interest rates increase over that time? Well, if we were to see interest rates increase to 4%, that same budget of $1,400 a month, right, we've just lost 20 grand in purchasing power.
Mm-hmm.
Take that a step further. If it moves up to 4.5, right, we lose even more. Okay, so your budget now only can afford $360,000, right? So this is what your purchasing power means, and what does that mean for you? In all reality, this is important to be staying in communication with your mortgage lender if you're going to be looking at homes over the course of a couple months.
Yeah. And that's a great opportunity. You're leading right into this we're waiting. And there's a lot of different components for we're waiting. There's a lot of reasons that we hear all the time for we're waiting is, hey, we want to save up a little bit more for down payment, but have we talked about what a down payment really looks like? And have we gone over that? Well, we think that we need 20%, so we're going to wait to save up to 20%. Maybe we don't need that 20%. Maybe we can be as little as 3% and it still makes sense for us. And one thing that Caleb and I are constantly talking about is, what are interest rates right now? If you look right now, we're getting into this historically low interest rates. But we've also been on a roller coaster a little bit of seeing them go up. You were just saying to me before we started a couple of weeks ago, we were seeing them change within hours, going from 5% down to 3.5%. And so it's something that we're going to keep in communication and talk about. Maybe now waiting is not right. Interest rates are crazy low. You don't need that 20%. Maybe now is the right time to make that purchase. And we hear all sorts of different reasons for this waiting. And of course, we're always going to listen, and we're going to talk and walk you through when is an appropriate reason to and when's not. Something I hear on my side all the time is, well, hey, we're waiting for the right home to come up, and inventory is really low right now, so we want to wait until there's more homes. There's going to be less competition. We haven't seen our inventory really go up in huge amount of numbers for almost 4 years now. So waiting for higher inventory is not going to be a great reason to wait right now. What we should be doing is focusing on, what's the home for you? What's your criteria? Can we find a home that fits that criteria and a home that you're going to fall in love with? And even with 100 homes, 200 homes on market, I can guarantee you, with some diligence, with some paying attention, we can find that right home within a week or two.
Yeah, absolutely. So let's look at the cost of waiting. And for a lot of our borrowers, it's going to be buying versus renting.
Yes.
Chris, highlight here what it looks like to buy right now and then also to rent for the next 5 years.
Mm-hmm. Yeah. And, this is something that we will go over a bunch with our potential buyers as we talk about what is your current situation right now and what are you going to see if I bought now over the next 5 years. We got to think about that appreciation amount and how much that home that you've purchased is going to increase in value due to the market, due to the U.S. economy and all that. How much are we then going to be sitting on this extra equity amount where when we're renting, we're essentially throwing our money against the wall and we're not seeing us build into our larger nest egg that we then might be able to cash out on either by selling or by refinancing later down the road and have that chunk of money then to be able to use and to continue to grow our net wealth.
Absolutely. So if we look at this here, we're looking at the monthly expenditure. This is a $300,000 house with 10% down. If your monthly expenses in the beginning, it looks like, hey, you know what? Renting is actually a little bit cheaper, but rent goes up each month. And with fixed rate mortgage, you're not really seeing your rent go up because it's a fixed rate. The only thing that might increase is your homeowner's insurance or property taxes increase over that time, but it's not going to increase as drastically as what rent will increase over the course of 5 years. And so average market, we're assuming annual rent increase of 5%, right? You're looking at rent going up from $1,600 to almost $1,950, right? And in our area now, a $1,950 monthly payment is going to get you a 2 to 3 bedroom apartment in our area.
Yeah.
So as we move forward here, Chris, you were talking about appreciation gain, and that's what we're looking at here, right? You've got your $300,000 house. Over the course of 5 years, we've seen it go up in value $71,000, right? In 5 years, what does it look like to sell? What does that cost? I see the cost to sell there. You want to explain a little bit more?
And that's really important to touch on. So obviously there is a cost to real estate. And as we've gone over both on the buy side and the sell side, there's different costs. On the sell side, our costs are a little bit more. In Washington State, we're going to be covering the commissions of our real estate agents. And this is a question we get all the time. And of course, it's something we go over with all of our sellers, but it is built into the market. On average, we're seeing total commissions around 6%, which is the seller paying both their agent, their representative, as well as the buyer's representative. And Washington has set this up so that we, as your representative, aren't trying to upsell you to get a greater commission. We're going to get the commission that's set by the list side, and we don't have a whole lot of choice over that. So if it's the right home for you, we're not going to try to push you one direction or the other or get you to try to pay more to up our commission, because that's already been set for us by the listing side. So when you go to sell in that 5 years, you are going to have that added cost of paying the commissions. But when we look at what you've gained equity-wise over those 5 years, you're still sitting on this large chunk of equity that you're then going to be able to take and put into your next home. And now this increases your leverage on your purchase power for your next purchase. So we bought that starter home. We've been there for 5 years. Now we've got 2 more kids. We need another bedroom. Hey, look, we've got, $71,000 worth of equity in here of appreciation gain, plus the equity that we've already had. We can go and use this even after that cost to sell and put it into our next property. How about we hear a little bit then on the amortization side with what you're going to see on that?
Absolutely. And so when you're paying rent, you're paying someone else's mortgage, right? So when you're paying your own rent, your own mortgage, right, that's forced savings, right? So over that course of 5 years, when you're seeing your home appreciate in value, a part of your monthly payment is actually going to go towards paying down your loan.
Yeah.
Right? So while we see that home appreciate in value, we're also increasing our equity position in the home by simply paying our monthly mortgage.
Yeah.
So if we're looking at 5 years here, a standard payoff, you're looking at increasing your equity position in the home by $27,000. And so over the course of 5 years, the net gain on buying a home, our home has increased in value by around $75,000. Our amortization has also given us an extra $25,000. The cost of both the initial loan and then the cost of selling that loan, you're walking away with $75,000 that you might not have already had, and that only gets larger as time goes on. And you've already talked about the leveraging that income later on down the line. And so as we've already talked a little bit about that, let's talk about getting going. And so the steps in your next house, Chris, you want to walk us through these?
Definitely. And we touched on this in the beginning, and now we're gonna finish with it as well, which is, now that we've had that initial conversation, now that we've gone through the pre-approval process, we know what we can afford. Now we're gonna find the right home. So we're gonna talk about, again, okay, we got pre-approved to this amount. What do we want to be paying a month? Where do we fall within that bracket? And we're gonna, balance that with, what do we want in a home? We don't ever want to get into the situation where we're house poor and that we spent all of our money and now all of our monthly income is going to paying that monthly mortgage. And that's something that Caleb is going to help us with when we say, okay, this is what we want. This is what we want to pay. Where can we find the middle ground between these two? Or, hey, with these payments, again, maybe we could want more and we can reach a little bit further. I really want that shop garage. We can afford it. Let's go for it. Let's go find it. Then we're going to find the right home. We're going to walk through it. Again, I really truly believe, and my experience has been, when we find that home that checks all the boxes and we get inside, there's just this feeling of belonging. And it can happen slowly. It can happen quickly. Sometimes it's immediate. Sometimes we start looking and seeing all the great features and it just builds and builds and builds. And we go, this is the one for us. And then we're going to put that offer in on the home. We might have to negotiate the offer back and forth with the seller to find that happy middle ground, or maybe our offer is just amazing and we've tailored it perfectly for them, as we always try to do, and we get the acceptance right away. And now we're going to be moving into that contract scenario that we just kind of been going over. And the number one thing in this market is act fast. And that we are a fast-paced moving market, and we have been for quite some time. We're seeing homes last on market on average anywhere from 3 to 7 days, and sometimes even quicker. Some homes have review dates set where we know that there is a date that all offers are going to be reviewed, and so we're kind of planning for that date, but we might still want to put our offer in first to give us that little leg up and say, hey, we were on the ball, Johnny on the spot, we're ready to go. Maybe we'll get that response first, even if we weren't the highest offer or had the best terms for the seller. So acting fast is extremely important in this market. And we're here to help you with that by setting up searches, by making sure we're tailoring our searches to be as close and specific as possible, while also understanding sometimes homes fall a little bit outside of what you really thought you wanted, but it actually turns out to be the perfect fit. And that's where we're helped to kind of try to guide you through that process.
Absolutely. And so that's, like you were just talking about, Chris, what you can expect with your group.
Yeah, we pride ourselves on not only meeting but exceeding the expectations of our clients. So, there's a lot of information that you can find online, and there's also just a lot of perception about the real estate industry. Sometimes, you can be like, oh, we're just working with a used car salesman, and that's not at all how we want to present ourselves. A car sale happens in a couple of hours. You're going to be buying and then living in that home for years. In the transaction process with just myself and with Caleb, we're going to be together for at least a month, if not a couple of months. So we really want to make sure that you trust us, that we set our expectations at the beginning, that we follow through with those expectations. We're always going to communicate with you. Like I said earlier, it really can make and break a real estate transaction is the communication. We're always going to be on top of it, giving you updates. Even when there's not an update to give, we're going to be reaching out and making sure you feel like we're staying in contact. And then Caleb and I are going to communicate ourselves so that I don't have to be calling Caleb and saying, hey, where are we at right now? They asked me a question, I can't answer it. I'm already going to know because I've already talked to Caleb. And if it's a question that I'm not going to answer, I'll direct you over to Caleb and say, hey, Caleb's going to be your best source for answering this so that I don't give you some misinformation. Our worlds, while intertwined, are completely different, and we're both educated, but we have our specialties, and that's why we work so well together.
Absolutely. And so the next steps here are you're setting up a buyer consultation, and then Chris is going to send you back to us, right?
Yep.
Application. We're getting you pre-approved. We're going to set a mortgage planning meeting where that's where we're going to build out. Hey, what does this monthly payment look like? And then finally, you're going to leave that with an understanding of what does it mean to get a home loan, and then you're going to be looking at buying that house with Chris. And
Yeah.
so finally here, if you do have any questions, Chris's information, my information is on the website. And so please do not hesitate to reach out. We hope this was educational. Chris, any last touches?
No, I just wanted to thank you again so much for helping us put this together. I do have a team that I work with here at Washburn. We've got some great agents that we partner with. So we're able to facilitate no matter the time of day. Just reach out to us. We'll get right back with you. If it's a question that Caleb can answer, I'll shoot you over to Caleb and get you guys connected. If you reach out to Caleb and it's a question I can answer, he'll have you come over to me and we can sit down and make sure that you feel comfortable moving forward. But this has been great. I hope you guys enjoyed it. Like Caleb said, don't hesitate to reach out. We're here to help, and hope you guys have a great rest of your day.